What's going on, everybody? It's Jeff here. Welcome back to the channel. What an insanely volatile Monday. Take a look at this chart right here. Never seen this really on a Sunday open besides for a couple different events. One was the Russian invasion of Ukraine, and also was the COVID crisis when there was some massive lockdowns. Sunday, we did have the futures contract rollover. Sunday night into early this morning, massive rally. Okay, up almost 100 points from where it opened at, only to fall 140 points to rally again another 100 points. Massive volatility. VIX was sitting at a high of 31 before cooling off. And I want to talk about the changes that are happening as of right now. Okay, investors have really started to price in and expect some serious changes. These are the biggest changes that we have seen over the past year and a half, and I want to share them with you guys. So first of all, obviously you've heard about this entire weekend. Okay, Silicon Valley Bank going under, as well as First Bank of Republic. There was a couple other banks having as of trouble. I'm sorry, they don't come to mind as of me right now. However, this was the big one. Silicon Valley going under. A lot of people talking about 2008 and so forth. One thing I did mention to everybody inside the group is I was expecting the government to step in and ensure that 100% of bank deposits would be covered. Okay. Now, they did this back in 2008. However, they used taxpayer dollars, a little bit different. Silicon Valley does have a little bit more assets than some of the other ones that went under in 2008. The reason why the government needed to come in and ensure 100% of bank deposits is because you better believe every single person out there who has over $250,000 inside the banks would have pulled that money. They would have transferred that money. They would have moved that money. That is what is known as a bank run. Government needed to protect that. That would have been a massive fallout. Okay. So that was, priced in, expected to happen. That's why you saw these futures rip overnight, only to kind of get a little bit pulled. Now we're getting into this insane volatility. We do have CPI tomorrow. CPI expectations are expected to come in really a little bit, lighter than usual. This is going to be the second month that they are pricing or calculating CPI, the new model. Okay, so obviously there is a little bit of, motivation and indication that this kind of can be manipulated to show that inflation is cooling a little bit quicker than, let's say, the reality. All right, obviously you and I, we all go shopping and we still see these prices climbing and climbing month over month on all the commodities, necessities, groceries, etc. Okay, but here's where the big change is happening. Okay, inflation is still out of control. Jerome Powell has stated 2%. They want to get to 2%. They want to get for 2%. We've talked about we have to wait until something breaks, right? You've heard this fear and this panic all over the internet. Something's got to break. Something's got to give. Well, Silicon Valley Bank going under, the government stepping in, to take control of this. This is the first sign that something has broke, okay? And what happens when something breaks? The Federal Reserve needs to step in and say, wait a minute, we don't know if we can continue raising interest rates as high as we have been, because obviously it's put a serious amount of pressure, okay? Now, right now, if you're looking at this chart, 50% of investors are pricing that in just about 8 or 9 days from now, the Federal Reserve is not going to raise interest rates. Okay, you look at what it was priced in a week ago, all right, and 2 weeks ago, we were thinking, wait a minute, there might even be a 50 basis point. We just went from 25 basis point. Jerome Powell might go back to 50 basis points because the previous CPI, PPI, and PCE all came in hotter than expected. Now they are pricing in, listen, we're not going to raise rates any higher. Reason being is because the banks cannot handle it. So you have two, big catalysts. We have the economy, inflation. You have the American people. We can't handle this inflation. However, you also have the other side where it's the banks. They can't handle the stress of the Federal Reserve raising interest rates as quickly and as rapidly as they have. Now, to you and I, oh yeah, it's slow and so forth. To the banks, it's put a severe amount of stress on them. Clearly, as we can see, not all of them. Obviously, they get managed a little bit differently. Here's where things change even further. Now, I've talked about the three phases, right, of the Fed pivot. The first one was going to be the slowdown of the rate hikes. The second one was going to be the pausing of the rate hikes. The third one is going to be the actual pivot. Now, based on history, during every single phase, it is short-term bullish. Okay, investors get a little sigh of relief. Your high growth, your tech sector gets a little bit of a pop. Market likes it. Market likes to rally. We've seen this time and time. You've watched me. If you've been watching my channel, I've covered this chart numerous times. However, what history also does show is by the time that there is an actual reduction, right, where they do, go back to cutting rates, the market pulls. Well, why does the market pull when they're cutting rates? When throughout the first two phases, the market likes it. It means that the Federal Reserve, okay, if they are cutting rates, it's an indication that the economy cannot handle their rates going high, and therefore the economy is in trouble. The market is forward looking, 9 to 12 months forward looking, okay, and the market tends to pull back. So that's why you're seeing a lot of volatility happen today. Initially, awesome rate hikes. Wait a minute. That means the economy can't handle it. Here we are pulling back. A lot of volatility, and obviously, guys, we have CPI, up tomorrow. So normally you'd expect a low volume chop day. Not the case today. Here's where things change even further. You look at some of the future projections, right? This is for March. Obviously, we're what, 9 days away from that. You go out to June and to see where they're priced in. Same kind of situation, right? 4.5%, not really raising. You go all the way out to November, okay? In November, a majority of investors are pricing in that rates are going to be cut by 50 basis points or even higher. You go a year out from now, okay? A year out. And investors are pricing in, over 50% are priced in that we are going to cut rates 1.5% from where we are as of right now. Massive change. Now, here's where the kind of contradiction comes in. And like I just kind of explained a moment ago, normally you think the market would be ripping because every time there's been indication, okay, from a federal, reserve member speaking, Bostic says this, Bullard says that. And every time it's been pausing, slowing, the market rallies. But now it's kind of in that panic mode. It's because the economy cannot handle it. It's going to be very, very interesting, not only to see where CPI and PPI come in, okay, the producer price index over the next 2 days, but what is specifically done at this meeting. Now, what is done, what is said. As you can see, this already changed a little bit since I refreshed it because the market did have a little bit of an end of day sell-off, but it'll be very interesting to see exactly what happens. This could be phase 2 where we get the pause. They're also going to want to hear any indication on projection, okay, where they see that terminal rate going to be. Is that number still in that 5.1%? Because as of right now, we are not going to get there. You zoom out to May, same thing. Most people are pricing in, we're not going to be there. This is 70% to under 50 basis point or 500 basis points, which would be 5% Fed fund rate. So like I said, guys, big changes happening. You kind of have a huge contradiction. The one thing that we don't want to hear, and I really wouldn't say this as stock traders, but as just an everyday American, and especially for all of our families, is that, wait a minute, maybe our target's not going to be 2% inflation, that we're going to go and we're going to shoot for, obviously, I don't think they're going to say 5%, but let's say they say, we're going to shoot for 3.5% inflation. That is going to be very difficult for Americans to survive. Okay. And not only that, the federal government is just going to continue going into farther debt, and we're really just kicking the can down the road. Okay. So guys, that's it for this video. I'll see you in the next one.